Hey everybody, Brian Shannon here from Alphatrends.net. Today is Friday, March 28th, 2014. Let's look at these markets here. We did have a down week for the S&P 500, lost about 0.5%, and the NASDAQ down 2%, brought it back into the negative column year to date, whereas the Russell 2000 lost 3.6%, is also in that negative column. So it's clearly starting out to be a year for traders so far, as the markets have been pretty back and forth mixed, and we are down now in the NASDAQ and Russell 2000. Semiconductors lost a little bit of ground, but they remain one of the stronger groups here, up 5.6%. So let's take a look at the charts and see where we are. Here's the S&P 500. You can see we still remain above this little band of support right in here that we've been referencing for a couple weeks, and above that 50-day moving average as well. So really, optimistically, we're holding above this support level, but if we see that we continue to deteriorate with lower highs, then it's possible that next week we might be in for some further decline here. Right now, it is the more impressive market that it holds up, and if we take a look at the 65-minute chart here, we can see that taking a look at as we have these Fibonacci levels, retracement of the year low, that is for this year obviously, not the 52-week low, but the 2014 low to the 2014 high. If we saw the market pull back down to the 38.2% retracement, that would get us down towards that 183 level, and that's approximately where we see the 50-day moving average, 183.51. So the S&P 500, really you have to look at it as neutral to slightly negative. We are below a declining 5-day moving average, so that's where we give the benefit of the doubt intermediate term to the sellers here. It's the buyers who have to prove themselves to be able to get back above that 5-day moving average and see that 5-day moving average flat to advancing, and then higher highs and higher lows above it. For the NASDAQ, which you can see here on the 30-minute chart, we are still below that declining 5-day moving average, and we have a pattern of lower highs and lower lows where prior support is turning into resistance as this market continues to deteriorate. Now in here, when we take a look at the Fibonacci levels, the year low so far is down here just under 84. Up to that high, you can see that we came down and tested the 68.2%, 61.8% retracement of that range. So 61.8% got us down to about 86.5, and so far the market's trying. The best scenario you could say is that it's trying to find support there. However, Friday's action with that gap up, a run, and then the pullback doesn't really leave a lot of confidence for the buyers going into next week. When we look at a slightly longer term chart here, you can see we're right at that 100-day moving average, and the 100-day moving average has provided support in the past. If it breaks, then I would expect that we would probably head back down towards the 85 level here over the next couple weeks. So keep an eye on that. We are on this trend line / 100-day moving average, and it offers the potential for support, but there's no advantage to being a buyer for intermediate term trades while the 5-day moving average is still declining like it is in here. So going into next week for the NASDAQ rather, we have to maintain a very cautious outlook. Again, we are negative year to date as well. We're down just over 1% in the NASDAQ. So we have to be, again, very cautious going into next week. We saw a lot of NASDAQ stocks break down, and we'll discuss those here shortly. For the Russell 2000, we had lost that key band of support in here between 116.5 and 117, and now any rallies we'll be looking closely at that to see if it holds as resistance. We are below a 50-day moving average, and bullishly, the most bullish thing you could say is that we came down to a 50% retracement and a prior level of resistance. So let's take a look on the intraday time frame what that Fibonacci looks like here of the year-to-date range. We've got the 50% retracement right in here at about 114, and just below that we have this prior little area of resistance. So really, if you take a look at this market, I think 113.5 to 114, here's our best potential for support for the Russell 2000 going into next week. If we stabilize in there and we see the 5-day moving average begin to turn higher, then we could look for a bounce. But right now, from an intermediate term perspective, it remains guilty till proven innocent. There's no advantage to being early in here, unless, of course, you gap up. But then that's more a case of what I consider to be gambling. The odds don't favor that we're going to turn around here. So we have to look at it and say we're in a potential area of support, but until the buyers show up definitively, there is no actual support. We've seen in this market, of course, that the 150-day moving average was tested on that last pullback, the year-to-date low, and now we can kind of draw a trend line that looks something like this. And the next bigger area, I think, is probably down near about 112 112 right about 112 actually. So that is also, if you see in here, 112 and a half. So 112 to 112 and a half is a potential level of support as well. It doesn't mean a place to buy. It means that if the pattern of lower highs and lower lows continues, here's a possible place where we would look for evidence that the buyers are showing up and regaining control. And as we see here on the 10-minute time frame, there is no such evidence in the Russell 2000 that buyers are gaining control. Same can be said, well, actually that's not true. For the semiconductors, if we look in here, we do still have this little trend line that's looking like it's relevant, and we're holding the 20-day moving average. That's the blue line. So if we look at a intraday time frame, what we saw this week was a key level of support that we had referenced a number of times at $44.40, that level held. Now, if we break down below that next week and then that and stay below 44.40 for more than a half hour or so, then I think it's highly likely that we would drop down to some of these other levels, such as that trend line that I just referenced, and that would also, well, I'm sorry, the trend line is actually slightly below that support area. But what we would be looking for our next potential band of support would actually be down here near about 43.65 to about 43.80. Daily time frame is still in a nice uptrend, but it's getting very volatile up here, and volatility often peaks near turning points. So that's something to keep us, staying defensive. Now, on the upside, if we were to get the semiconductors back above Friday's high. Friday's high was 45.21. If we get above and hold above there, then it's possible that we could see this market continue to move higher, as the path of resistance is higher on the daily time frame, but it is getting choppy up in here, so it's very indecisive. The financials lost a little bit of ground this week, and they've been a strong group this year, but if we take a look in here again at the 65-minute time frame, we can take a look at some Fibonacci in here. That's our year-to-date range. We're close to that 38.2% retracement. We also have a trend line we can draw off of that low, and you can see that that trend line was broken, and now we have this prior little area of support right here at about 22.30 that offers the potential for resistance. So we're going to need to see the financials get it back above 22.30 at a minimum to get a little bit more positive, more neutral actually. It would be 22.25 to 22.30. That's our potential band of resistance. If we can get above and hold above there, then the financials have the possibility of continuing higher rather. Otherwise, we would be looking for them to pull back to this prior resistance area here at that again at this level right in here between basically 2180 to 2185. Here's our potential next support level. That's where we had resistance in the past, and that's about that 38.2% retracement. Looking at gold, gold lost some ground this week. It was down about 3%. And here's the danger of using moving averages as a system. A lot of people want to buy the pullback to the 10-day moving average, and that'll work sometimes. The 20-day moving average will work sometimes, and they're just reference points that we want to see. We don't want to be buyers there. We want to see on an intraday time frame is there evidence that the buyers are gaining control, and with it below a declining 5-day moving average, the answer is clearly no, it's not. So gold seems like it should be able to continue lower a little bit in here. If we take a look at the year-to-date range for gold, it is still in a nice uptrend, of course, and we're right at a 50% retracement, so it seems as though it's likely to turn higher higher again, but there's no evidence of it yet. Seems like isn't a reason to buy. Apple had a break of a range that we were looking at this week. We were talking about a break beyond this level in here as being bullish. Unfortunately, however, though it gave back almost entirely all that gain, we are still holding above the gap area, which I suppose is bullish, and we have a rising 10 and 20-day moving average. Also, we have a rising 50-day moving average. So we had a light volume pullback. Apple isn't quite dead yet. It's violated a tight stop that I had suggested, but maybe back above 540 next week, Apple could have the ability to continue to move higher. Shares of Tesla did lose ground, of course, below that 230 level, and we came down to the rising 50-day moving average. Now, this stock is trying to find some support in there. However, I think that it's more likely we will continue to drift down below 200 here in the next week or two. So it's not ready to be bought yet. The only, the bullishly, I would say that if we get back above Friday's high near about 217, maybe we could make a run for this prior support area, but that would just be for a short-term trade. Tesla's going to need some time to heal. This week we saw a lot of stocks. Momentum names get hit hard. The CAMP, CSOD was another one that got hit real hard. And these have been, nice uptrending stocks. If you look at CAMP, it's been in a beautiful uptrend, pulling back pretty hard. Shares of Data, Tableau, had a tough week as well. And the reason I want to mention these stocks in particular is, again, a lot of people look at the 50-day moving average and say, hey, the 50-day moving average is support. It wasn't support in any of these stocks. There's, the CSOD, the CAMP, Dunkin' Donuts, it's trying to find support there. And the way you want to look at a moving average is to say, okay, well, what do we have in this area that's been important in the past? This prior resistance has the potential to become support, but it isn't support yet. It's the potential for support. The 50-day moving average often acts as support on a pullback when it's rising. So we look to the shorter term time frame and look for evidence that the buyers are taking control. Just to put your buy order in at 49.73, because that's where the 50-day moving average is really an uneducated way to get involved. Now, big institutions may be accumulating the shares near that 50-day moving average, and if that's the case, what happens is we see the trend slow down, we start to see some sideways action, and then we wait for that 5-day moving average to kind of flatten out again. So it's still early on all of these stocks to be looking at them as buys for something that could continue back in the uptrend. Facebook is another one. Facebook found support at its rising 50-day moving average earlier this year, but just sliced through it. Now for a day and a half, it came down and touched that level, and you can see in here, though, where that 50-day moving average was touched right here at about 64.85. There was no evidence in here that it was actually in a condition to be able to continue to its advance, because we had that declining 5-day moving average and we had this prior support close by, which had the potential to be resistance. We look at it as guilty till proven innocent. We want to see it prove itself. For Facebook, it might have looked something more like this to be a buy. That is, maybe it would have gone and then broken this little resistance. At that point, that 5-day moving average would have flattened out and perhaps begun to turn higher. So by being early, you expose yourself. Buying the dips has been a good strategy for a while. The market's been in a 5-year bull market, and it seems as though some of these high flyers are just not finding the support where people expect them to. And the point is that you just don't want to be early, because it can be so costly to buy a stock like FireEye, because you think it's down from 100 down to 75. You think you're getting a deal, but then it drops another 10 points, 12 points from there. Is really just a brutal way to be involved in the market. And you can see here we've had this declining 5-day moving average, and while we're above it, it's still guilty till proven innocent. We want to see it flatten out and then make a higher high above it. Then perhaps FireEye is more in a accumulative phase, phase that has the potential to move higher next week, but the evidence still isn't there yet. I'd spoken about the biotech index on Yahoo Finance, saying that it seemed as though, coming down towards 235 was where it had the potential to find support, because that's also where we saw that 100-day moving average. So here we'd seen the 100-day moving average act as support numerous times, and this was the potential area of support because we had seen this support in here and the 100-day moving average. So that's where we wanted to look for the potential to buy the biotechs. But what we saw instead was, the market started to try to turn sideways in there, but the buyers simply didn't have enough power to get it back above a 5-day moving average and see that 5-day moving average flatten out. If we were going to bounce, it would have been more something like this. Now we still have to look at these biotechs as they're guilty till proven innocent in the intermediate term. They're close to down for the year and erasing a big gain after they've been in this huge uptrend for a while. So the evidence simply isn't there yet for the purchase to purchase it. We saw a disaster in a IPO, and to try to think that what it's worth is really so far Wall Street is saying it's worth less than it was the day before and the day before that. So we want to look at it and say it's got a pattern of lower highs and lower lows. There's no reason to be buying it. Same is true. Netflix got hit hard this week, and there was a couple reasons to think maybe it was going to find support. We have this longer term trend line here that perhaps we're going to find some support. We're at a rising 150-day moving average. But when we look to the shorter term time frames, we still see a market where we have lower highs and lower lows, and we have a 5-day moving average that's declining sharply. So stay away from them. They're being sold by big money, and right now you can say, well, maybe it's going to close the gap or whatever. But the point is, until the stock actually shows signs that it's being accumulated, and here we started, it looked like maybe it was going to undergo some accumulation. What we would have wanted to see was something that looked more like this, and then to break beyond that 5-day moving average, see the 5-day moving average flatten out, and have that higher high above that 5-day moving average. Again, that's not something that we saw. So there's a lot of danger in this market. Sale, people bought this one over here thinking it was a good deal because it was at the 5-day moving, at the 50-day moving average. But even on this one, when you look back to where we were 2 weeks ago when it hit 37 for the first time, at 37 bucks a share, that's where it hit that 50-day moving average and it bounced right up to the declining 5-day moving average, and it continues to be sold off, and people are getting hurt badly in these types of names that have had these big runs and are now experiencing the deeper pullbacks. We saw it in SFUN, we saw it in Sohu, we saw it in SPLK. The list goes on and on. TripAdvisors, Visa was a nasty reversal where it looked like it was breaking out and then it broke down. So from this failed breakout came a fast move lower. The point is there's a lot of danger in this market right now. You could look at a stock such as Microsoft. Still looks like maybe it has the potential to be able to continue to move higher as this one holds up beyond that multi-year breakout. But you've got to listen to the message of the market. The market is saying we're in a riskier environment. Risk management, I always say it, is job number one. That's what I focus on bringing to subscribers to Alphatrends each and every day, and I invite you to come take a free trial. So have a good weekend, and hope it was a decent week for you trading.